Investing. Every seasoned investor has their own opinions, their own theories, and champion themselves as successful investors. Self-confidence or conviction has a role to play when making investment decisions. But so does humility. Let's talk about the investment mindset. Welcome to another episode of Money Matters. Don't look very hard and you'll easily find so-called gurus ready to share their secret to investment success. Whether it's stock market investing, forex, DeFi, etc., these nobodies have chosen to mentor you because it's your lucky day. They have a program to teach you the tricks of the trade, to read the markets, and special methods to quickly make money from the financial markets. Yes, make money on the side and eventually quit your day job and become a hero day trader living like a baller, whatever that means. That's the pitch at least. And here's the truth of the matter. No one has the secret. If they did, you certainly wouldn't hear about it. Think about it. Why would they tell you when they have the secret? They would have the means to live the high life that they are selling and forget about wasting time trying to teach you too. Yes, a simple click on the link and that's your shortcut to becoming wealthy and financially independent. If we look at professional investors for a moment, these investors usually have a preferred style of investing. They have formed opinions over the years of investment experience. And some are adamant that their style of investment is superior. After all, what sort of a professional would they be if they didn't have some degree of self-belief that they are better than the competition? Maybe they like large cap, small cap, growth stocks or value stocks. Perhaps they specifically like tech firms or hard commodities. Wealth managers and investment products usually adhere to certain investment themes. That's what they specialize in, that's their style. Therefore, a mutual fund that calls itself a US equity fund will obviously have its holdings on US stocks. A wealth manager who has been managing fixed income assets for their entire career will likely remain as a fixed income manager for the rest of their career. That's just how the investment world works, and there's nothing wrong with that. However, when managers claim that their investments or style of investments are the best, then that's simply not true. What does that even mean? No one investment style or asset type has proven to be consistently outperforming the others. Historical data has shown that when one style of investing is winning big, it doesn't stay top for long. Towards the tail end of the 1990s, many investors were hot on large growth stocks because large growth had done so well during that period, and particularly those on the tech bandwagon. Except not long after, large growth and tech got destroyed in the 2000 to 2003 bear. As a consequence, small caps gained favor again. Then, up until the global financial crisis in 2007, non-US stocks led the way. And then following the crisis, these stocks were some of the worst categories. I hope we're all seeing the point here. You can see from this table of the best and worst performing categories from 2007 to 2021. No one category remains on top for long. Try as you may, it's nigh on impossible to know what will perform next, no matter what any wealth manager might say. It pays to remain flexible in your thinking, to remain grounded and humble in your views, to remain open-minded and challenge yourself as an investor. Humility goes a long way. It's totally fine to omit certain investments from your fund or portfolio if you don't feel comfortable buying those type of investments. The point is not to be too stuck in your ways when making investment decisions. The more conviction you have in your views, the more chance you have to win big, but at the same time, the more risk you take on in losing big. It's like trying to guess which sports team will win the English Premier League or the playoffs in the NBA before the season has even begun. Sure, you can probably make an educated guess on which handful of teams are likely to win, but don't go all in on one team. unless that team is your own team, but then that's an emotional choice. For nearly all investors, it pays to remain diversified. Diversification is a type of risk management. Instead of betting on any one category, you are betting on the financial markets as a whole. You are betting that the human race will progress as a species and that the world will continue to advance and grow. And you can bank on the financial markets always eventually rising. You can find my video on why markets always eventually rise. Or just do the research yourself. Take the S&P 500 index here from 1991 to the present. It goes through the dot-com bubble bursting in 2000, the global financial crisis in 2007, 2008, and the most recent global pandemic in 2020 as being the three most notable events along the way. There have, of course, been many other corrections in the market, but when we take the long-term perspective like we have here, they almost seem forgettable, and that's the point of taking the long view and proving that markets always and eventually go on the rise. Whilst I don't want to discourage anyone from having conviction in general, you have to have some self-belief in life in general. But when it comes to investing, do so with a modest proportion of your overall investment portfolio and build up from there. A lot of my clients like to play with a proportion of their wealth, but it's only ever a modest proportion. The majority, which funds their children's education, their retirement, and their future aspirations in general, largely tracks the global markets and ride the ebb and flow of the markets and makes decent returns. Often their own fund accounts cannot keep up with their bigger portfolio. The average return trails even though they sometimes capture big wins. The same mindset applies to those thinking they can time in and out of the market, seeking to make super gains on the market upswings and mitigate all losses on the market downturns. I don't blame anyone for trying. After all, behavioral finance tells us that we feel the pain from losses twice as much as we feel the pleasure from gains. But it doesn't work, and here's why. Corrections and crashes happen quick and happen big. By the time you've seen it, it's already too late. If you do pull the trigger and sell at a low price, be ready for a big rebound. But this time you're out of the market and not riding the rebound. Another one bites the dust. Rebounds are like compressed springs. The bigger the compression, the greater the rebound. For longer, more sustained market downturns, you may have a chance of mitigating some of the losses on its downward run. But when do you enter back into the market? Assuming you can identify a rebound, how long will it last? And if it doesn't take you back beyond the price you sold it, would you even call it a rebound? Remember, it's easy to look back after it's all happened and say you should have done this and should have done that. But that's with hindsight. In the heat of the moment, looking through the fog, it's impossible to know where the market's heading just by looking in the rearview mirror. You need to make a judgment call based on research and analysis. And that often means going against the consensus because any information you have absorbed is already publicly known information and is priced in. What you're saying by attempting to time in and out of the market is that you know better than others, and you think that the market will move a certain way. There are other reasons why timing the market doesn't work, including more transaction costs and the opportunity cost of being out of the market, let alone committing the time to constantly monitor markets. You can find my video on 5 reasons why timing the market doesn't work. But as I alluded to earlier, don't let me discourage you too much. If you really want to get your hands dirty, try it out on a smaller account, maybe 100,000 alongside your 10 million globally diversified buy and hold account, and see if you can outpace it. Good luck. Finally, don't be overly reliant on any one source of information. No one person has all the answers, and everyone has an agenda, including yours truly. Even emulating our investment heroes may not be a good idea. Their investment objective may be very different to yours, including major parameters such as risk tolerance, time horizon, and liquidity levels. Your investment portfolio must be tailored for your own specific needs, which are in line with your bigger picture goals. We may all want to retire at some point, but beyond that commonality, our specific needs are different. Which is why at JS Wealth, we believe in bespoke solutions for our clients. No one family or individual is the same. So I'm afraid there is no shortcut to investment success, no secret sauce. There is no reward without risk, no output without input. However, do not be discouraged. Keep on learning, which is why these videos exist. Read as much as you can from as many different viewpoints as you can. Go ahead and experiment with small amounts of money that won't hurt. There's no substitute for experience. Whatever stage you're in, whatever investment style, whatever your investment motivations, I wish you all the very best of luck. Keep on investing and keep on winning. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.